Question 39. Petro Inc. buys 80% of the outstanding common stock of Sierra Corporation on January 1st, 2018 for $802,720. Okay, so now we know that 80% of the control interest fair value is this amount. At acquisition date, Sierra's total fair value, including the non-controlling interest, was assessed at this $1,003,400. So which means that even though the fair value of non-controlling interest is not given, but we can derive it indirectly by using the total fair value minus the fair value of the controlling interest. Okay, and then Sierra's book value was only $690,000, so book value is given. Also, individual account, several individual items on Sierra's financial record had fair values that differ from their book value as follows. Okay, so those are very important information. We can use them to calculate the excess annual amortization expense. Alright, and then in this part are the 2018's year-end account balance for the two companies. Okay, so the question is asking us to prepare a worksheet to consolidate the financial statement of these two companies. In order to prepare a worksheet, normally we need to prepare the consolidation entries first. And in order to get the consolidation entries, the step one is to prepare the allocation schedule of acquisition date subsidiary fair value. Okay, so here is the allocation schedule I prepared. And let's start with the total fair value in this transaction. So total fair value here include two parts. One part is the 80% controlling interest, and the other part is the 20% non-controlling interest. And the 80% controlling interest fair value is given directly. That is total consideration and transferred by the parent company. And then there's additional 20% non-controlling interest. And that number can be calculated indirectly by using the total fair value and minus the 18% controlling interest fair value, because we know how much is the total assets fair value. And then next, book value acquired, 690,000 is given in the question, and then we can get the excess amount of fair value over book value. It equal to $313,400. All right, so the last step here is to allocate those excess amount to those accounts with different fair value from book value. And information also given directly. And so we can calculate what's the difference amount by using its fair value minus the book values. So land, you can see that is undervalued by $225,000. Building equipment is overvalued by $24,000. Copyright is undervalued by $94,000. Note payable is overvalued by $18,400. And then let's put their remaining life. Normally we do not depreciate land. Building and equipment have 10-year life. Copyright 20 years. Notes payable during 8 years. And then we can get annual amortization related to each account. And then the total amount is going to be $4,600 per year in total. As to the goodwill, so for this question, if we use the total excess amount minus the total difference coming from those accounts, we see that there's nothing left. So which means that the balance of goodwill is 0. Alright, so that's a step 1. And then the next step, I'm going to prepare the consolidation entries for you. Because we know that this parent company is using equity method, so there's going to be 5 consolidation entries. So the first is entry S. Entry S is to eliminate the subsidiary company's equity account. So let's go back here. We have 3 equity accounts that we need to take care of that. Common stock, additional paid-in capital, and beginning retained earnings. And both the account and balance are available here, so we can use them directly. Okay, and as we debit common stock, additional paid-in capital, and beginning retained earnings. Oops. And then we credit investment in Sierra and credit non-controlling interest in Sierra. Alright, so the balance for common stock is 100,000. For addition paid in capital, 60,000. And beginning retained earnings, 530,000. And then that's the total debit, and we are going to allocate 80% of the total debit to the investment account, that is 552,000, and allocate the remaining 20% to the non-controlling interest, which is 138,000. Alright, so this is the entry S. Next one is going to be entry A. Entry A is to adjust those subsidiaries account that with a different fair value from book value, adjust those account to its fair value, and then we know that we have a full account to adjust. The first one is land, second one is copyright. For those ones we need to debit them, and the last to debit is notes payable. And those accounts are for the asset, those assets are undervalued, and for those payable is overvalued. And then we credit buildings because building is overvalued. Alright, and then those are the full account that have a different fair value from book value, and then we credit investment in Sierra and non-controlling interest in Sierra. So as to the amount here, so the amount here all comes from this access annual amortization schedule. They are here. That's what we use. Okay, 225,000, 94,000, and 18,400. So buildings balance is 24,000. Okay, still investment in Sierra gonna get 80% of the balance, the 250,720. Non-controlling interest get 20%, 6,680. Alright, so that's entry A. Next one is going to be entry SAI. Entry I is to eliminate the inter-entity, the income, investment income from Sierra, and the amount will be over here. It's kind of given directly. Equity in income of Sierra, so we are going to remove this amount from the parent company book. So a debit income from Sierra and credit investment. $177,000 and 120. Next one is going to remove the inter-entity dividend payment. That is entry D. So entry D with debit investment, Sierra and credit dividend. From Sierra, and then the total amount here would be dividend. Okay, so the total dividend declared by the subsidiary company is 65,000, and as to the parent company, they're only going to get 80% of that. So the amount here in our entry would be 52,000. So it's going to be 5,200. Let me check the amount. Okay. Oh, sorry, 52 dividend, 52,000. That's 80% of the total dividend paid. This is 52. Okay, so last one, entry E. Entry E is to recognize the excess annual amortization expense, and we can record them one by one individually, like one for buildings, one for the amortization expense, and one for the interest. So the first one is let's do this for the buildings. So debit, because the building is undervalued or overvalued, so debit the buildings, and credit depreciation expense of 2,400. Next one is copyright, so debit amortization expense. The last one is the overvalued notes payable with debit interest expense, and credit notes payable. $2,300. Alright, so that's all the journal entries, consolidation entries we need to prepare. And next step is to transfer the dollar amount from the entries to the worksheet. Now let's complete this worksheet to consolidate the financial information of the two companies. And the difference between the worksheet of this chapter and the worksheet of the last chapter is this part related to non-controlling interest. So first, that we are going to have a new column called non-controlling interest, and also under the income statement we are going to have the item related to how much net income is going to be allocated to non-controlling interest and how much is to the controlling interest. And also at the bottom of the table, and we are going to have something related to the non-controlling interest in balance. And first we're going to have the beginning balance of non-controlling interest, and then we're going to have a ending balance of non-controlling interest in the subsidiary company. Okay, so come back to this question. The other part is going to be basically the same as chapter 3. We're going to input the entry SAIDE's information into this table, and then same time we're going to complete this column for non-controlling interest. So, well, if you can have those consolidated entries handy or in another piece of paper, so we can input the numbers into the worksheet one by one. First is entry S. So entry S is to eliminate the subsidiary company's equity account. So which means that here we're going to debit 100,000 common stock and debit 60,000 additional paid-in capital, and then debit 530,000 retained earnings, and then we credit the investment account by the total of 552,000. And remember, there's another part related to the non-controlling interest. We debit here in entry S. We credit 138,000 non-controlling interest. All right. So then let's move on. Entry A. Entry A, we debit 225,000 land, and then we debit 94,000 copyright, and then we debit goodwill. Oh, there's no goodwill. And then we credit the buildings and equipment. So we credit 24,000 of that. And we credit $250,720 investment income, and then we credit 62,680 non-controlling interest. Okay, so that's SA entry I. Entry I is to eliminate this inter-entity income from sales. So we debit 177,000 120. We credit actually I 177 120. Okay, and the next is to eliminate the intra-entity dividend paid. So we debit. Here we're going to debit the dividend 52,000 and credit the dividend related to 52,000. And then there's going to be another 20% of dividend paid to the non-controlling interest. That's 13,000. And as to the net income to non-controlling interest, the amount here would be 44,280. How we get this amount? It equals to the sales net income here minus the excess annual amortization and then times 20%. So we can get this net income to non-controlling interest. Okay, I say I, D, and then last one is E. E is to take care of those annual amortization expense. Okay, so in E, we are going to have a credit 2,400 depreciation expense, and we debit 4,700 amortization, and we debit 2,300 interest expense. So related to this three expense, we did 2,400. So for the building equipment, we debit 2,400, and then for copyright, we credit 4,700, and then for the notes payable, we credit 2,300. Alright, and then the last part is not the last part, and also for the non-controlling interest, what we can do is that we can kind of summarize what is the balance of non-controlling interest in over here. That's going to be 231,960. Okay, so that's going to be the ending balance of a non-controlling interest. It will equal to its beginning balance and then plus net income and minus dividend. In general speaking, that's how we calculate non-controlling interest balance. As to the other part, we just add those numbers across those columns and get the consolidated totals and make sure that there are a few things. Make sure that they are zero. For example, it would be 0 here, right? 0 for the income of the investment, and then it will be 0 in the investment account. That's some key things. Alright, so that's the solution to this question.
Hi, Professor. I just had a question in the special problem for this particular problem in Chapter 4. For B, it wanted us to do for the 2022 consolidate entry worksheets, but with the income changing and the dividends, I'm not for sure how I would impact and put the numbers in there. Do leave everything else the same, and I'm assuming we still take the amortization or the depreciation expense for the current assets and the accounts payable into matter. If you could break that down, that's the only problem that I had. Everything else made sense to me. Thank you.